Welcome to the Grab the Map podcast, where we don't just look at it, grab the map. I'm your host, Johnoson Crutchfield, and you might be listening to this somewhere on Apple or Spotify, but you also can roll over to YouTube. Look for the Grab the Map podcast on YouTube. Pretty excited about what's going on over there because y'all are watching the content and commenting and all that good stuff. So if you want to listen to more of these, hear more of these conversations, just subscribe, like, review, give us 5 stars if possible so that it gets to more people. Glad to be able to talk to you today, Arn, on the podcast. What's cool about this conversation is I can ask Arn anything because we don't have a topic planned or any type of formal conversation planned. I'm excited about these because when Arn tells us he's 70, he's been in the business, he's seen a few things. These are actually my favorite conversations. My favorite conversations are with people that have been in the business. They've seen market cycles go up and down. Arn was talking about that at the beginning of the chat. If they left that clip in here, this was my first downturn, right? For those of us who got in 2015, 2016, 2017, we just rode up. We just rode out. COVID helped us even more because we got a COVID bump in values. And then interest rates rose to that 2022. The 2023 period where we started, I would say, going into a mild season of recession. I would be careful with the word there, but that's just the timeline. Today, if you're listening to this in the future, we're recording this in the fall of 2024 when we're right on the precipice of the Fed. Maybe. Arn's got his fingers crossed. You're not watching this on YouTube. Maybe reducing interest rates. Arn, you've kind of alluded to this, but let's just go back to the beginning. You could think about when you were getting started, why you got into the business, and then why you chose the lane you're in now.
Yeah, so great question. I didn't have any real great plan. I was a typical middle income, middle class American kid. Parents told me, work hard at school, do well, go to college, yada, yada, yada. And I was on that path, ended up in grad school, actually got a master's in, of all things, physical chemistry from the University of Michigan. And then came to the realization being a research scientist really wasn't my gig. I'm kind of more a social person. Also wanted to return to the Bay Area where I grew up and most of my life, and called my dad. My dad said, come on out, get your license and I'll put you to work. He was a residential broker and he was a single family home investor. And as my brokerage business grew, I started investing in single family homes. And I did that for probably 30, 35 years, both in California. And I had the good fortune to jump into Austin, Texas around 2000 and rode that wave. About 10 years ago, moved to Greenville, South Carolina, right when COVID hit. A young investor friend of mine here, Mario Brown, gave me a call. We talked, what do you think is going to happen with COVID and rent collection? And I said, I don't know. We'll just find out. He turned me on to a podcast at the end of the conversation, and it was about multifamily real estate. And that kind of set a light bulb off in my head where I went from single family to multifamily. And that's what I've been doing the last 4 years. I would say any kind of investing in real estate can work. And for each of us, I think we got to find what kind of makes sense for us, what we enjoy doing. It could be flipping. It could be buying single family homes and accumulating them. At one point, I probably had 30 single family homes across the country. They did very well for me. And then I decided to move to multifamily. One, because multifamily is more a team activity. You can have partners, and I enjoy the social aspects of partnering with individuals in multifamily. And in addition, there's things I'm very good at. There's things I'm not so good at. There's things I enjoy doing, things I don't enjoy doing. Going to multifamily allowed me to find partnerships and partners with folks who have different skill sets than I. And I believe in multifamily. We understand in the United States, we have a problem with affordable housing, and certainly apartments are one of the most affordable options for people in the United States. And so there's strong demand for multifamily, and I think that will bode well in the future.
We definitely have a housing shortage in America. We definitely have a housing shortage in places like beautiful, sunny, the Carolinas. So you're definitely in the market. That makes a lot of sense. Some people might argue better than the Bay Area, right? Which still seems to be appreciating though.
Hey, look, there's no shortage of $3 million homes, okay? The shortage isn't in the Bay Area. So I hear you. The Bay Area is an interesting market because basically it's a global market and people from all over the world want to come there to find their fame and fortune. But I would say it's the exception rather than the rule.
Absolutely. Absolutely. So you work today primarily with people who want to invest in multifamily and they want to build their wealth through real estate investing. What would you say your superpower is on the team that you work with or with Spark?
Yeah, great questions. One, I think I'm a great team builder, and I found two really good partners. Brian Walsh, who does a great job actually running the asset, the physical asset, dealing with the tenants, rent, renovations, repairs, maintenance. He loves doing it and he's exceptional at doing it. And then my other partner, Dan, is kind of a spreadsheet geek. He's great at underwriting, loves numbers. He's early 50s, just left his W-2 after a long career as a CFO. So he knows budgeting, forecasting, income and expenses, and now he's a full-time real estate investor. My superpower is networking, hunting deals, bringing people together, talking to investors. And so the three of us have complementary skill sets and the team's working well. So I like to find the deals and then I turn them over to Brian to operate. Quite honestly, the day-to-day operation isn't what gets my heart pumping. It's finding that great property that has a lot of potential and bringing it to our investors.
Yeah, so I know that's a skill that I've seen you use in your business, right? The ability to attract investors, to also project the confidence in the deal. And also, I think what I appreciate most about some of your posts is how you mitigate risk in your projects. So can you talk a little bit about how you mitigate risk in your projects when you're first finding that deal, and then also how you communicate how you're mitigating that risk to your investors?
Yeah, thank you for the compliment. And I'm kind of a old school investor, and I kind of have fundamental principles. My father taught me the business, and he was born in 1921, so he actually lived through the Depression. And somebody who has suffered that has a kind of a perspective. So for me, real estate investing is about capital preservation. It's about fixed rate debt. It's about not over leveraging the property. And it's about having ample cash reserves for when Murphy's Law strikes. The other thing I would say, over 45 years in the industry, the overall trend in real estate values, rents, prices is up. And that's undisputable. And typically what I see is 5, 6, 7 years of boom, maybe 1 or 2 years of a slight downturn, 1 or 2 years of a kind of plateau. And that just sets the stage for the next run up. And so if you buy real estate in a prudent manner, which means fixed rate debt, low leverage, most of our deals, we only leverage 60 to 70%. So we have a good solid down payment. We also close them with cash in the bank to handle unforeseen problems. if you set the deal up that way, then you can ride out the turbulence. And Johnson made a comment about right now we're having a little bit of turbulence, but I promise you, if you can ride through this we've been in turbulence maybe 12 to 18 months, maybe we got another 6 to 12 months to go. But if you can ride through that, I promise you the value of all the real estate you own 5 years from now is going to be more. So that's how we mitigate risk. And that's what we communicate to our investors. And certainly having a reserve fund might reduce returns perhaps 1% or 2%. But in our mind, the way we approach investing is line drive base hits, not swinging for the fences, not swinging for the grand slam, just steady gain over time, kind of a 5, 10, 15-year time period. So we set the deals up to protect us on the downside while we still benefit from the upside.
Yeah, I like it. I like it. So I think if you wrote a prescription for things I need to implement in my business or have been doing over the last couple of years, I'm trying to get to where you describe, right? Let's have adequate reserves. Let's make sure that we're in it for the long term, right? Let's make sure that we're really properly underwriting our deals and understand the expenses that are going into the business. Because on the real estate rental side of things, it is a 5-year journey, it seems. It's not a get rich quick thing, right?
We kind of got spoiled a little bit. You mentioned like 2018, 19, 20, unbelievably low interest rates, cap rates dropping. And so things were easy. And sometimes we get fooled and we forget that things aren't easy. It's a lesson we can all learn. It's a lesson we can all be reminded about. But long term, you're going to win. Just got to set it up properly. And I think the other thing that this last year or two has talked about is you do need to know how to actually operate rental real estate. You have to know how to lease it. You have to know how to maintain it. In 2018, 19, 20, people could do well even if they really weren't good operators. But in a normal market, you need to be a good operator. It's a business. It's like any other business. And if you can minimize expenses 3 or 4%, and you can increase rental income 3 or 4%, that increase in the net operating income makes the difference. And generally what I do is I encourage people to start small. And I realize some gurus say otherwise, but to me, I think you start small. You buy a couple rentals, then maybe you move up to a 4-plex, maybe an 8-unit building. And once you learn how to operate, then maybe you jump to a 40-unit building and you build up systematically. Doing it that way, you're secure. Here's the way I would describe it. If you were a first-time skier, would you go up to the top of the mountain and jump off a black double diamond slope? I would say probably not. If you did that, you might hurt yourself. You would start on the bunny slopes, you'd move up to the blue, and as you gain experience, you take on more difficult terrain. I think investing is the same way. Start small, get your feet wet, gain experience, and as you gain experience, scale up. And of course, when you're working with investors, why are they going to invest your money with you or anyone? They're only going to invest their money with you if they think you're maybe a little better real estate investor than they are, right? So you got to build up and gain that experience. It'd be the same thing going to a doctor. Say you had a heart issue, needed heart surgery. Would you like your surgeon to have 5 to 10 years experience or be just out of medical school? I'd submit you'd want to have a heart surgeon that has done 500 of those same kind of surgeries. So build up slowly, steadily, you'll win the game.
Yeah, I think that's not something both of us are active on social media and on LinkedIn. And so it's been a powerful tool for me in terms of networking. I don't have an entrepreneurial family at all. I'm the only entrepreneur in my family, certainly the only real estate entrepreneur in my family. And it's allowed me to meet other people that are in the business. The mindset of an entrepreneur is totally different than the mindset of an employee. So being able to meet people from South Carolina or California for that matter is very valuable. And the advent of social media groups and Facebook groups and all of that has been helpful. However, as many people find out, there's tons of courses and programs and masterminds and things built to generate revenue for the gurus, and slow results don't always sell the courses, right? So when we say that, we've got to keep in mind that we're in this for the long term, right? The staying power is very important. I appreciate you for sharing that. So if you don't mind, can you talk us through a deal that you're working right now? Maybe the numbers on the deal, the location, what has you excited about it? And then I want you to just share a little bit about how people can reach out to you, Arn, if they're interested in working with you.
Thank you. I do have a deal under contract here in Greenville. It's a sub 50 unit deal. It's a heavy value add. It's in an area that we believe has great long-term potential. The current owner is actually the second generation who owns it. So the current owner inherited it from his mom and dad. So you can imagine they probably owned it 30, 40 years. It was built about 1970, needs some work, fairly good price per door. Rents are very low. And so our plan there will be to go in, improve the units, raise rents gently, be respectful of the residents, but try to bring them up to market as time goes on. So that's a deal we're currently in due diligence on. It's a 506B. We generally do 506B deals, which are available to sophisticated investors and accredited investors with a prior relationship. So I can't say much more. What we have recently closed on is some new build duplex construction. Last deal we bought 13 duplexes, 26 units in total, 2-story duplexes, 1 common wall, 2-bedroom, 2.5-bath, 1,100 square foot units, slab construction, vinyl exterior, but we did get granted an LVP. We paid about $175 a door, about $160 a square foot, which given construction costs is a pretty good price. And we're renting those units for about $1,500 a month. So not a great cash flow deal right now, but we believe it's self-supporting. Rents will go up, and the value will increase over time. And when we exit in 7 to 10 years, we'll still have relatively new product. We're projecting about 6% average cash on cash return over 5 years and about a 14% IRR to the limited partners. So again, not a deal that jumps out that this is the deal of the century, but I think just a good, solid investment people can make, feel their capital is secure, and over time that they'll benefit for it. So we like actually the smaller deals. We feel we can get in, get control of the asset, turn it around if need be. And so that's the kind of deals we do here in Greenville, South Carolina. My other partner, Brian, is located here too. And then Dan, who does the numbers, is up in Raleigh, North Carolina, which is only about 3 hours away. So we believe in, one of the things I say is an investor's competitive advantage is their local market knowledge. And to the degree you have superior local market knowledge, you're going to do better with investments. So that's what we do. I'm active on social media, both Facebook and LinkedIn, either under Arn Cenedella or Spark Investment Group. Website is investwithspark.com.
Awesome. Arn, thank you so much for taking the time to jump on our podcast. This has been the Grab the Map podcast. Don't forget, you all, if you want to reach out to me, you can certainly find me at Grab the Map on Instagram, social media. If you want to reach out to Arn, we'll put his contact information in the show notes. Don't just look at it, folks. Grab the map.